On the 18th of June 2020, a company listed among Germany's 30 largest told the market that 1.9 billion euros of its cash could not be located. That figure was roughly a quarter of its entire balance sheet. Over the following days, the story did not get better. It got worse. The money had not been stolen. It had not been misplaced. It had never existed at all. Wirecard was not an obscure venture. It was a member of the DAX, the index of Germany's blue-chip corporations, which it had joined in September 2018 by pushing out Commerzbank, a 150-year-old bank displaced by a fintech. At its peak, the shares traded around 190 euros, valuing the company near 24 billion euros. For a brief moment, this payments processor from a Munich suburb was worth more than Deutsche Bank itself. To understand how 1.9 billion euros can be imaginary, you first have to understand what Wirecard claimed to be. On paper, it was a payments company, the plumbing that carries money from a shopper's card to a merchant's account, taking a small fee on every transaction. That is a real, dull, low-margin business. The problem was that Wirecard reported margins a genuine payments processor does not earn. The explanation for those margins is where the fraud lived. In regions where it held no payment license, the Middle East, Southeast Asia, Wirecard said it did not process transactions itself. Instead, it outsourced the work to independent local partners, who ran the payments and passed Wirecard its cut. The industry term is third-party acquiring. 3 partners carried most of it, a firm called Al-Alam in Dubai, Senjo in Singapore, and PayEasy in the Philippines. Investigators would later find these partners were tiny, hollow, or simply fictitious. This outsourced business was not a footnote. It supposedly generated roughly half of all reported revenue and close to the entirety of operating profit. In other words, almost all of the money that made Wirecard look like a hyper-profitable growth machine came from the one part of the company that outsiders could not see, could not audit, and could not independently confirm. Here is the structural tell that a trader learns to distrust. The cash those partners earned did not flow back into Wirecard's own operating accounts. It was said to sit in escrow trustee accounts in Asia, held as security for the acquiring business. That arrangement was very convenient. It explained why the money could never be freely spent, never moved, never independently traced. It was cash the company supposedly owned, but that no outsider could ever touch. Year after year, that escrow balance grew, until the headline figure reached 1.9 billion euros, about a quarter of the company's entire balance sheet. Consider what that means. A genuine payments processor does not hold a quarter of its assets as idle cash sitting in third-party escrow accounts in the Philippines. It puts capital to work. Wirecard's single largest asset was money it claimed to own but never used. The entire structure rested on a single weak joint. Nobody ever confirmed the balances with the banks directly. Instead, the numbers were verified through a trustee based in Singapore, who produced documents on what appeared to be bank letterhead. For years, the auditors accepted screenshots, faxes, and PDF copies as proof that the money was there. No independent party ever sent a confirmation letter to the bank and waited for the bank itself to reply. That omission is what held the fraud together. Someone, though, was looking closely. In 2015, a Financial Times reporter named Dan McCrum, tipped off by a short seller who had bet against the stock, began publishing a series called The House of Wirecard. He questioned the accounting, the acquisitions, and the gap between the reported cash and the underlying business. The company denied everything, and for a while, the market believed the company. The reporting sharpened. On the 30th of January, 2019, the FT published internal documents suggesting forged and backdated contracts run out of the Singapore office, evidence that revenue was being invented. In October, it went to the core, publishing internal spreadsheets indicating that the third-party profits themselves appeared fabricated, and that partner cash may have been double-counted. The whistleblower behind much of it was not an outsider. It was Wirecard's own head of legal in Singapore. A guilty company opens its books to clear its name. Wirecard did the opposite. It sued. It surveilled. It hired investigators to track the journalists and the short sellers betting against it. And in the most extraordinary turn of the whole affair, Germany's own financial regulator did not turn on the company. It turned on the people raising the alarm. In February 2019, the regulator, BaFin, did something it had never done before and has never done since. It banned the short selling of a single stock, Wirecard, for 2 months, treating a market-wide emergency tool as a shield for one company. It also filed criminal complaints against the FT journalists for suspected market manipulation, on the theory the reporting was coordinated with the shorts. No charges ever resulted. The regulator had prosecuted the messengers and protected the fraud. By late 2019, under pressure from its own investors, Wirecard hired KPMG to run a special independent audit, designed, the company hoped, to end the questions for good. On the 28th of April 2020, the report arrived. KPMG said it could not verify the third-party profits for 2016 through 2018. The audit commission to clear the company instead confirmed the void at its center. The shares fell about 26%. This is the moment an accounting fraud turns into a solvency event. The fictitious cash was not merely there to flatter the profit line. On a balance sheet, cash is collateral. Lenders and rating agencies looked at that 1.9 billion euros and saw a safe, cash-rich company. On the strength of an asset that did not exist, Wirecard borrowed money that very much did. The mechanics are worth stating plainly. Backed by a balance sheet showing that phantom cash, Wirecard earned an investment-grade credit rating. It drew on a revolving credit line of 1.75 billion euros from a syndicate of around 15 banks. It sold 500 million euros of bonds to investors. Every euro of that was real money, lent, and invested against a cash cushion that was pure fabrication. Even SoftBank appeared to endorse the story, agreeing in April 2019 to a 900 million euro convertible bond, announced at the height of the FT pressure, and read by the market as a vote of confidence. But the structure was telling. SoftBank had the exposure repackaged and sold on to other institutional investors before the collapse. It kept the headline halo and the upside, and passed the downside to someone else. The end, when it came, took 7 days. On the 18th of June, 2020, EY, the auditor that had signed Wirecard's accounts for over a decade, finally refused to sign off on the numbers. It had at long last done the obvious thing, demanded confirmation of the escrow cash directly from the banks that supposedly held it. Wirecard disclosed that 1.9 billion euros was missing, citing what it called spurious balance confirmations. The answer from the banks was immediate and flat. The two Philippine institutions named as custodians, BDO Unibank and the Bank of the Philippine Islands, said they had no relationship with Wirecard whatsoever. The documents naming them were forgeries, complete with fake signatures of their officers. The Central Bank of the Philippines confirmed that the 1.9 billion euros had never entered the Philippine financial system. There was no account. There was no money. The market did the arithmetic in hours. The shares fell more than 60% in a single day. On the 22nd of June, Wirecard's own board conceded that the 1.9 billion euros most likely did not exist and withdrew years of financial results. On the 25th of June, 2020, the company filed for insolvency, the first member of the DAX in the index's history ever to collapse. Chief Executive Marcus Braun resigned on the 19th of June, then turned himself in, arrested on suspicion of accounting fraud and market manipulation, and released on €5 million bail. He has denied the charges and maintains that he too was a victim deceived, he says, by others inside the company. His trial in Munich, one of the largest fraud proceedings in German post-war history, is still running. No verdict has yet been reached. His chief operating officer told a different kind of story. Jan Marsalek ran the Asian operations, the third-party partners, the escrow, the part of the company that was fake. He did not stay to answer for it. Within days of his dismissal, a private jet carried him from Austria to Minsk, in Belarus, and onward toward Moscow. Investigative outlets have since reported that Marsalek had long been an asset of Russian intelligence. He remains a fugitive, on international most wanted lists to this day. Strip away the private jet and the espionage, and the failure at the heart of this is mundane. For at least 3 years, EY relied on screenshots and documents supplied by Wirecard and its own trustee, rather than confirming the balances with the banks that supposedly held them. Independent bank confirmation, a letter sent to the bank, and returned directly by the bank, is one of the first procedures taught in auditing. Had EY simply done it, the fraud was detectable years earlier. The damage was real even though the cash was not. Wirecard collapsed owing roughly €3.5 billion to its banks and to its bondholders. Nearly 6,000 employees across 26 countries lost their jobs. Shareholders were wiped out almost entirely. BaFin's president resigned over the regulatory failure, and Germany rewrote its laws on audit oversight and financial supervision, raising the bar it had let Wirecard walk under for a decade. Here, then, is the autopsy. Wirecard did not lose €1.9 billion. It never had it. The genius and the fatal flaw were the same thing. The fake cash was not hidden in a drawer. It was posted on the balance sheet as collateral, the collateral that made the credit rating, the bank line, and the bonds possible. A fraud that size can survive audits for 10 years. What it cannot survive is a single confirmation letter sent to the right bank. The auditors did not send that letter for a decade. When they finally did, the company was insolvent in 7 days.